we're in good shape. Today we're doing chapter 8, okay? And chapter 8 is on budgeting. So it's chapter 8 and it's on budgeting. And I was talking to my daughter, and my daughter's a CPA, and she was going, I'd invite you to class on Tuesday, but I know what you'd say about budgeting. And she goes, Dad, they're all make-believe numbers, you know? All they do is make up numbers, and then they expect me as the accountant to make them all work. And it's a little, cynical, what have you. But to some extent, I can see it kind of both ways. Back when I was in business, I was in sales, and I had to put together a sales budget. And everything starts with the sales budget, as you saw from the reading. And from that perspective, I went client by client, okay? And I said, this is a current client. This is how much of business I can expect from them this year. This is what I think we can do. And then, and so that was pretty much a given. So, I mean, when I would disagree with my daughter that those numbers were made up, then the next step was new business. And new business is kind of a shot in the dark. That being said, I always knew what customers I'd been working with. I knew which ones were, let's say, better potentials than others, okay? And then beyond that, I just kind of, said, hey, this is what I think we're going to get out of, these various new customers, what have you. And so then I'd have a budget for me, and the other salesmen would do the same thing. And then we'd have an office and then ultimately a company budget. And usually this started, and this was always hard to believe, in August or maybe September at the latest for the new year. And the goal was always to be done by Thanksgiving. So when you left for Thanksgiving, the budget for the next year was done and ready to go. And everybody knew what was going to be expected in the next year. So that's kind of, where they are time frame wise. They're great for planning. From an accountant's perspective, to be honest, sometimes to kind of, use my daughter's, they're a pain in the butt, okay? And what will happen, especially from an accounting perspective, is somebody will come to you and go, I need to change one number. And the thing that they don't realize is that it's not just one number, okay? And the best example I'd have of that is, imagine a car, okay? And imagine they come back to you and they say, we're going to produce one fewer car next year. Just one. We're Ford, we're GM, whatever, we're just one. Okay, that means I need 4 less tires. I need 1 less engine. I need 4 fewer doors, assuming it's a 4-door car. I need 1 fewer trunk. All of a sudden, every part in there has a budget. And every one of those budgets change, okay? Which then changes all my accounts payable for every one of my suppliers, okay? It changes my revenue. All of a sudden, everything changed, even though it's only, to use one car. And so they're important planning tools, what have you. But I don't think a lot of people realize that, man, just changing one item really changes a lot. So let's start with exercise 8.1. And 8.1 is on page 383. Let me see. Yes, 383. Keep in mind, everything starts with a sales budget. And I was just looking at the problems we were going to do today, and we're not doing, I don't think, a sales budget one. But that's okay. Okay, so let's take a moment here and take a look at what we're doing on this. And what we have in exercise 8.1 is we're doing an expected cash collection. Okay, so we're doing expected cash collections, and we're doing it for the second quarter. Okay, and so we're doing it for April, May, and June. And then this is the total or the quarter. And most of these, to be honest, most of the problems is homework and what have you. It's just thinking logically about the problem. Now, notice what it says, and this is pretty common. Notice from past experience, the company's learned that 20% of a month's sales are collected in the month of sale, 70% are collected in the month following sale, and the remaining 10% are collected in the second month. Bad debts are negligible and can be ignored, and it depends upon the type of business as far as what those percentages are. But what that means is starting with February, okay, I am going to be collecting February sales, because keep in mind, we've got Feb, March, and April. So I am going to be collecting 10% of February sales in April. So that's going to be a 10%. So February sales were 230 grand. So I'm going to collect 23 grand from February. In March, okay, March sales were 260 grand. And I am going to collect 70% in 10%, 70% in April, and 10% in May. So they were 260 grand at 70%, that's 182 grand. And in May's is 26 grand. So in May, I'm going to collect 26 grand of that 260. Gotta work on my. And now I've got April's. In April, keep in mind, my April sales were 300 grand. Okay, and that's going to be 20, 70, 10. I'm going to collect 20% in the month of sales, 70% the following month, 10% the month after that. Keep in mind, this is a great example of those companies going back to last semester that are offering terms. 210 net 30, those types of things, that's where you're going to see this. At Walmart, it's less of an issue because basically, I would argue all the sales at Walmart are cash sales, okay? When you go into Walmart and you pay with your debit card or your credit card, they're typically going to get paid for that in about 2 days, maybe 3. If you give cash or you know, things like that, it's going to be that day. So Walmart really is kind of almost a cash business, okay? Whereas those firms that do 210 net 30 and what have you and give you terms like that are going to be the ones that are going to have situations like this. So we're going to have 60 grand that we're going to collect in April, 210 grand that we're going to collect in May, and in June it will be 30,000. So that'll be April sales. May sales, and May sales were 500 grand. And that's going to be 20, 70, and 10 as well. And once you get those percentages down, what have you, so I'm going to collect 100 grand in May. I'm going to collect 350 grand in June. And I'm going to put the other 50 grand up here because I want to talk about that just briefly as we finish up this problem. So I'm going to put that up there. And then finally, I have June's sales. Okay, and June sales were 200 grand. And I'm only going to collect 20% of that. So I'm only going to be able to collect 40 grand in June. And the other 160, I'm going to put up here. Okay. And I'll talk about why I'm doing that here in a sec, but I'm going to put that up there. Okay, now I can go ahead and run my totals. And my totals here will be 265, 310, 336, and 390, 420. So that's a total of 1,021,000. And God willing, you know, we'll have the 23,000 from April, the 188, 208. This is just really to make sure everything matches up. We've got 90, we've got 300 grand. We've got 450 and 40. And God willing, that'll also be 1,021,000. Okay. Oh, I guess Now, a couple of quick notes here. Okay. And I'm going to use April's. No, let's use May's. Just note, in May, I sold $500,000 worth of stuff. Okay. And the reason why these budgets become so important is I sold $500,000 stuff. If I'm paying commissions, my salesmen are going to expect to be paid for that. If I'm building something or what have you, I'm going to have to pay my suppliers. Okay. But notice in May, I've only collected 336 grand in cash. Okay. I've only collected 336 grand in cash, but I had $500,000 in sales. So depending upon how my outflows go, I may be caught short a ton of money. Okay. If I run to my banker in May and go, oh crud, my salesmen want to be paid and I don't have enough money because I didn't collect enough. They're going to go, what were you thinking? What kind of budgeting are you doing? What kind of accounting are you doing? I'm not giving you a loan at the last minute. If you go to them in March and say, look, or if you have a line of credit, which a lot of companies do, have a line of credit and say, look, in May, I'm expecting sales of $500,000. But my cash receipts are only going to run 336. I'm going to be short. I want to arrange a loan now. If you go to them in March and say, hey, May's typically, you know, a big month of sales, but I don't have the cash coming in. It comes in June. I sell only 200 grand, but it comes in June. I can pay you back 30 days later or whatever the numbers work out. They're going to be a lot more likely to look favorably on your business. So the key to budgeting is to know when these cash flow issues arise so you can prearrange with the bankers, whether it's through a line of credit or some other way, so that when you do run into shortages, you know, it's not the end of the world. And I can't tell you the number of especially small businesses that don't do this. And they end up at the end of the month putting it on a credit card at 18% interest instead of 6 or 7 perhaps at the bank these days. Okay. Or they go to their employees, and my wife's worked for these companies. They go to their employees and say, listen, we're not going to pay you this week. Or we'll write you a check, but don't cash it. There's no money to, you know. My wife's worked for, if you've worked for small businesses, you've worked in situations like that. Okay. And it's because they haven't done the planning to go ahead and do what's necessary. Okay. So that's part one. Part two is what I was putting up here. So I'm going to go ahead and move it down here. That's part one. Part two, I'm going to go ahead and and put down here. I put the numbers up top. But remember from May, I didn't collect 10% of that 500 grand. So from May, I have 50 grand that I didn't collect. And from June, I only collected 20%, so I didn't collect 80%. 80% of 200 is 160. So that 210 grand is what's going to be at the end of the quarter. That is going to be my accounts receivable. It's going to show up on my balance sheet when I put together my quarter. You know, part of the purpose of this is to know how much stuff to order. How many parts do I need to order? When am I going to pay for it? What have you? But part of it is also so I can put together a quarterly balance sheet. So then I can tell my financial folks, my banker, he'll go, well, what do you expect your end of the quarter balance sheet to look like? Boom, I know what I can put in for accounts receivable. Do I need to know another number for cash? You betcha. Okay, and if you think about it, okay, I mean, if you think about a balance sheet, you've got, and I'm just going to do the assets, you've got cash, accounts receivable, inventories. Okay, I'm going to go building and equipment, building and land. In order to put together this simple balance sheet with these 5 items, these are the only 2 that theoretically have, I'm going to say, no change. There's going to be a little bit of a change due to things such as depreciation, what have you. But the building and land are going to be the only 3 items. When you're putting together a projected balance sheet at the end of the quarter, you know, what have you, or the end of the year, those are the only 2. All of these, you're going to have to get off the budget. You're going to have a cash budget. You're going to have an accounts receivable budget. You're going to have a budget for each of those inventory items. And you're going to have, that's where all those items are going to come from. Okay, that's where all those items are going to come from. Questions? If not, let's go on to exercise 8.2, which is right below. In fact, a number of these we're going to do just right in a row. We're going to just kind of, and once you get the hang of these, I mean, it's just kind of a logic, you know, a logic exercise as much as anything else. For exercise 8.2, okay, we're looking at a production budget. How many are we going to produce? Okay. And notice what it says there in that paragraph. The company is now in the process of preparing a production budget for the second quarter. Past experience has shown that end of month inventories must be equal to 10% of the following month's sales. And the inventory at the end of the March was 5,000 units. The reason is, and today's probably as good of a day as any, suppose you were doing the production budget for April, okay? You cannot start the month, which starts on Thursday, in 2 days now with no inventory. Because that means any orders you get Thursday or Friday of this week, you don't have the inventory to ship. So you're going to be out of stuff to ship. So that's not a good position to be in. So the first thing we got to think of is, okay, we need some, even though the month ends tomorrow, we need some sitting around on April 1st. So that's why they tell you the inventory needs to be 10% of the following month's sales. So let's do this. Once again, it's for the second quarter. There's April, May, June, and then the quarter. And we're going to have, let's go budgeted sales. And these numbers, I'm just going to take the given 50, 75, and 90. So that's 50 grand, 75 grand, 90 grand, and a total of 215. Okay, so that's my budgeted sales. Okay. Now I'm going to add my desired ending inventory. Keep in mind, at the end of April, I want to make sure that I've got some in store on May 1st to supply any orders. And their desired ending inventory is 10% of the next month's sales. 10% is perfectly, I'm going to say, reasonable. Okay. It's about 2 or 3 days worth of sales if you think about it. Okay. There's about 30 days in a month. You know, keep in mind, I'm not worried about holidays and weekends and those types of things. There's about 30 days in a month. So by wanting 10%, you probably want 3 or 4, 2 or 3 days worth of inventory on hand, which seems reasonable. Okay. So that means in April, I want to produce 7,500. So I have 7,500 of those available on May 1st. In May, I want to produce 9,000. Okay. And in June, I have to look at what July's sales were. And that's why they told me July's sales were are expected to be 80 grand. So that's my desired ending inventory. So I add those two, and that's my total needs. $57,500, 84 grand, 170. Not 80 grand, 8 grand, folks. %. So that's 98 grand. Okay. Now some interesting things begin to happen here, and I'm doing this for the quarter as we go. The question comes up, okay, for the top row, I added 50 plus 75 plus 90 to get that 215. Okay. But my desired ending inventory, I just take this last number because that's what it's going to be at the end of the quarter. So that's going to be the 8 grand. And that way, when I add these three, 98 plus 84 plus 57.5, I don't even do that. My total needs will be 223. And note, I am not going to add these, because if I add those, I'm going to end up with more than 223. I'm just adding down for the quarter. And the reason is because this 8,000 is coming from, July, and this 7,500 is coming from over here. So I need to produce 223,000. Okay. Now I subtract my beginning inventories. My beginning inventory, they told me, was 5 grand. For May, it's going to be 7,500. And there it's going to be 9 grand. So my beginning inventory for the May is my ending inventory for April. So that's where I'm getting those. And then once again, the question is okay, what number do I put over here? Sorry about that. The garbage men are driving by. Dogs don't love the garbage man. And there, the beginning inventory is going to be the 5 grand. So now I've got my required production. And notice what happens. It's going to be 52,500. I'm selling only 50 grand, but I'm producing 52.5. Once again, this is the reason why those production guys, you know, you go to the production folks and you tell them, hey, I'm not, you know, we only sold 50,000, we made 52.5, and we made some because we're going to have a big month next month, but I'm not going to pay you. They're not going to be around for very long. Okay, they're not going to be around for very long. So there I'm producing 52.5. In May, 84,000 minus 7,500 is 76.5. And 98 minus 9 is 89 grand. And that 218 works. It works because it's 223 minus 5. It's also the sum of those. This is where Excel spreadsheets come in really handy, and you know, macros and all those types of things you learn in those IT classes. That's where putting together spreadsheets for all this stuff are really beneficial. Okay, so now we know, and keep in mind, why do I need, you know, why do I need to know that? In order to produce this, I needed to know sales. Okay. Now I know how many I'm going to produce during the quarter. I also know how many I'm going to produce every month. Now think about it. Now if I've got a assembly line or whatever, I know how many people I need to come into work. I know how many hours they have to work. I know how many pieces of steel or whatever it is I'm making I need to order. Okay, so all of this has got to be done. So, I mean, I start with sales, then I start figuring out production, and then I can start going into various parts. You know, how many gallons do I need to order of stuff? You know, my daughter works at a brewery, so it's, you know, how many pounds of hops do I have to order? How many pounds of you know, malts do I have to order, or grains do I have to order, and all that type of stuff. How much cleaning supplies do I need? What's the production schedule going to look like? Okay, all of that has to, you know, when you think about it, it's like, oh my God, there's a ton of planning to be done. Questions? Continuing on. 8.3. Other quick note here. I mean, once again, I'm talking to my daughter, what have you. We're talking about this. She's complaining, really, is what it boiled down to. And I mean, we talked about rolling budgets, and some companies do rolling budgets, and that's one of her griefs. Is they planned on the economy back in November being open in January, February, and March, if you will. And so they didn't give a lot of thought to their budget for the year, which one can explain. They're putting this together last August and September, or September and October. You know, who would have thought in March, a year later, we'd still all be closed and what have you. And so some of the things they budgeted for didn't occur. And so now they have to go through, and they realize after January and February, our budget for the year is shot. You know, so they're going through and re-looking at some of those items. And so it's like, okay, what do we need to do from here? And that was kind of part of her grief. So the first two here were based on months. The third, and we're going to do exercise 8.3.
Well, Professor Sass, before you move on, I might as well ask this because I'll just confuse myself later. So should the two in the second, the 8.2 exercise, should the end of the quarter and then required production, should they come out to 218? We're trying to get those to match up and down.
Yep. Yep.
Okay.
But it's the 223 minus the 5.
Okay.
Yep.
So, I didn't get that though. Oh, never mind. I see. It was just one little thing. I see where I made the mistake. So I got it now.
Okay.
All right, thank you.
No problem. I didn't do anything, but I'll take credit, I guess.
You just had to hold my hand through it. Then I saw what I did. Thanks.
No problem. How often you do a budget is kind of an interesting, I would suggest, monthly and quarterly. And what I was telling my daughter is that they should have a rolling budget. And I think that's what she's going to do. But the problem with even a rolling budget is she goes, then it's going to seem like we're never done, because every time, it's March. So we're going to roll this March off and we're going to roll another one on, down the road. So most of the time you would do it by month, I would think. Okay, I think that would give you the most accurate stuff. The next question, 8.3 does it quarterly. Okay, and really it doesn't, matter. I don't think you do a budget all that often quarterly, but I take the problems as they come, so to speak. Now 8.3 is interesting. This is a materials budget, and notice they have budgeted production in bottles, first, second, third, and fourth. So let's go ahead and go. Let's create my columns. First quarter, second, third, fourth. You probably want a year. Yeah, let's do the year. Okay. And then we take budgeted production. And for these numbers, I'm just going to take them right off. 60, 90, 150. So I've got 60 grand, 90 grand, 150, 100. And the total for the year then is 250, 400 grand. So we're going to produce 400,000 of grams of musk for some popular perfume. Okay. Now, a couple of things to note here. They gave us the first quarter of year 3. The reason they gave that is because I'm doing a materials budget. And just like for the last problem, I wanted some inventory left over at the end of the month for those orders that come in. I'm going to want some inventory of inputs sitting there so that, I don't want people to come in 2 days on April 1st and have no supplies because we used them all in March and Mr. Sass didn't plan. So I'm going to need that when I come over to the fourth quarter. Now you'll notice there in the first paragraph, it says that it takes 3 grams of musk oil for each bottle. So what I need to do is raw materials needed. And each one is going to take 3 grams. Now keep in mind, it's calculated in grams here. For you and I, we don't use grams, we use ounces. It doesn't matter. Don't let the grams or anything like that. The one beauty of this textbook is they used to do a bunch of stuff in different currencies and what have you. They've gotten rid of all that for the most part. So we don't have to worry about those things, but it really doesn't matter. Okay. So now the total raw materials needed. Good Lord, I got to work on my handwriting here, folks. Total raw materials needed is going to be 60. We're producing 60,000. Each one takes 3 grams, and these are in grams. Notice it's not in dollars. So that's 180, 270, 450, 300, and $1,200,000. Questions? Now what I need to do is I need to add my desired ending inventories. Okay, because these are stuff I want to buy. So I have to add my desired ending inventories. And it tells me that I want inventory of musk oil at the end of the quarter. It has to equal 20% of the following quarter's production needs. So I need 20% of my following. So I need 20% of the following quarter's production needs. So I need 20% of 270, which is 54,000. I need 20% of 450, which is 90 grand. 20% of 300 grand, which is 60 grand. And this is why they gave us that last column there for year 3. The first quarter is 70 grand. I need 20%. Okay. So that'll be 42 grand. And my ending inventory for the year will be 42 grand. That will be the amount from there. And that will tell me my total needs. Let's change color here. So my total needs are going to be 180 plus 54, so 234 grand. 270 plus 90 or 360. 450 plus 60 or 510. 300 plus 42 or 342. That is not 421,000. And 1,242,000. So those are my total needs. Less my beginning inventory. Okay, and it told me that the beginning inventory at the beginning was 36 grand. Some 36,000 grams. So I've got 36,000 grams. And that it gave me. Okay. But now it's going to be 54 grand. 90 grand, 60 grand. Keep in mind, this is my beginning inventory, so that's going to be 36 grand that goes there. So that's my total purchases. Okay, so I've got 234 minus 36. So my buyer needs to buy 189,000 grams during the quarter. He or she has to buy 306,000 grams during the quarter. 306, 420. 282. 1,206,000. Okay, now I'm an accountant. Do I really need to worry about how many purchases that they're making? And the answer is no. Okay, none of that is necessarily. I am going to have a purchasing manager or of some kind, whatever, and that purchasing manager is going to need to know those numbers. Okay, so the question is okay, I'm the accountant. What do I need to know? I have to multiply that by the unit cost. And it told me the unit cost was $1.50. That's what I really needed to know. Okay, so now that will tell me when I multiply that out, that will tell me my costs for raw materials purchased. That's what I need to know. Okay, I need to know what those costs are. I'll also need to figure out, this is where monthly will come in handy. Are they giving me terms 210 net 30? How much of this am I going to pay in, and I'm going to use the number, the quarter that's here, or is some of it going to hang over to the next quarter? I have to know how much I'm going to have to write those particular, those particular checks for. So I take 198,000 times $1.50 and I get 297 grand. 306 times $1.50 is going to be 459. 420 times $1.50 is going to be 630. Um, 282 times $1.50 is going to be 423. And 1,206 times $1.50 is going to be 1,809,000. So as an accountant here, those are the numbers that I'm going to need to go into my cash budget someplace. Okay, those are the numbers I'm going to need to put into my cash budget someplace. Questions? Let's continue on with aid 4. And once again, I mean, this is a direct labor budget. The question is who's going to put it together? And keep in mind, like in a manufacturing plant, I need to know what the sales numbers are before, as the plant manager, I know who's going to be working. Okay, I need to know what my output's going to be or needs to be before I can say, okay, who's going to be working, what have you. And then the accountant will have to go and put numbers to it. So here in A4, we have a direct labor budget. And once again, they're doing it by quarters. Okay. Probably want to do it by months, but we'll go with theirs. first, second, third, fourth, and year. And they told us required production. Okay, and that we got from a production budget, and that's 8,6,500, 8,6,500, $7,000 and 7,500 for a total of 29,000. So that's how many I'm going to produce. Now they've done some sort of a time study, and it's direct labor time per unit. And notice they gave us 0.35. Okay, they gave us 0.35. And so that's 0.35 of an hour. So a third of an hour, which, keep in mind, an hour is 60 minutes. So it's about 20 minutes, something like that. Okay. Per unit. So now it gives us total direct hours needed. So we're going to take 8,000 times 0.35, and we get 2,800. It'll give us 2275, 2450, and 7,500 is 2625. For a total of 10,150. So that's how many hours are needed. And keep in mind, that might very well be done by a production manager or what have you. Okay. And once again, it doesn't, from an accounting perspective, I mean, I may have done part of this, but from an accounting perspective, I need to know costs. I need to be able to budget costs. So now I need to know how much per hour. So we're going to direct labor cost per hour is $15. And one quick note, and I've seen companies, screw this up. If you're going to do something like $15, that's got to be your all-in cost. Okay, because you don't want to forget about things like Social Security tax that you're going to match. Okay, remember when your employer, when you see that $100 come out for Social Security, your boss had to match that. So, if you're paying them $15 an hour, you may very well have to put in 18 or 20 or whatever that number is, because you may need to include benefits, whatever else in there for that. So total direct labor cost is just those numbers times 15. So 2,800 times 15 is 42,000. These are numbers. These are going to go in my projected income statement. They're going to go into my projected costs. Some of it may very well go into my projected balance sheet. Okay, as salaries payable, things like that. 34,125. 36,750. 39,375. And 152,250. Questions? Last one I'm going to do before we take a look at, whoops, 8.6. So I'm skipping 8.5, going to 8.6. And notice what we're doing here. We're doing a selling, general, and administrative budget. Okay, we're doing a selling, general, and administrative budget. And once again, we're doing it by quarters. So we're going to have first, second, third, fourth, and year. And we have budgeted sales. And it's 15, 16, 14, 13. So it's 15,000, 16,000, 14,000, 13,000. And then for the year, it'll be the sum of those 30, 45, 58. Okay, so that's my sales, 58 grand in units. Then I'm going to my variable selling, general, and administrative. They told us it was 250 a unit. So we've got 250 a unit. Okay, so we can multiply those out. And that will give me my variable SG&A, and I should mark in here per unit. So my variable selling in general and administrative is 37.5. $40,000, 35 grand, 32 grand, and 145. Okay, so that's my fixed. Pardon me, my variable. So now my fixed. Okay, and notice we have here, we have a number of different items. Okay, and it's kind of all in the core, it's all in that paragraph there. So we're going to kind of have to, figure it out. The first one that's fixed is advertising, and that was fixed at 8,000 a quarter. $32 grand for the year. So that's easy. Okay, salaries are easy. They're fixed, executive salaries. And they were what, 35 grand? So that's 140. Now we have a couple of items that are only in a couple of quarters, which is very common. Okay, it's very common. Things like insurance are only in the first and third quarters. So we have insurance, 5,000 in the first, 5,000 in the third, Total 10 grand. That is not at all unheard of. Okay. Then we have property taxes. And property taxes are just in the second quarter. So we have property taxes. Also very common, once a year, have twice a year expense, what have you. Now becomes, and it's going to become more interesting even in a minute or two, depreciation. And it's 20 grand a quarter. $80 grand for the year. And the reason why I find this interesting is because depreciation, if you'll recall from last year, is a non-cash charge, i.e. there's no money going out for it. Okay, so there's no money going out for it. So the question is okay, why is it included here? And it's included here because it's an expense. Because I'm going to have to put together a budgeted income tax, a budgeted income statement. And for a budgeted income statement, I need to know what my expenses are. So I need to put it in to find out what are my expenses. So now I can add up my fixed costs. Okay. And my fixed costs are going to be the sum of those. So for the first one, it's 68 grand. 71 grand. 68 grand. 63 grand. For a total of 270. And notice the reason why they're different is because some items are not every month. Perfectly common. Even though they're fixed costs, they're not the same every month. Questions so far? Now I'm going to have my total variable and fixed cost. So I'm going to add my variable at the top to my fixed cost of 68, and I'm going to get 105.5. And I'm going to add that 71 to 40,000 and get 111. I'm going to add that 68 to 35 and get 103. And I'm going to add the 63 to 32.5 and get 95.5 for a total of 415. Those items are going to go onto my income statement, my budgeted income statement, as my expenses for each of those quarters. But now I have to do one other thing. I have to take out and go less depreciation. So I got to take 20 grand out. And when I do that, I'm going to get 105.5 minus 20, which is 85.5. And that's going to be my cash disbursements for SG&A, selling, general, and administrative. So I'm going to get 91. I'm going to get 83. I'm going to get 75.5 or 335. So those I should probably cut it off there. Those are going to go into my cash disbursements. So what shows up on my income statement doesn't necessarily show up as cash disbursements. And the reason why is because of depreciation. Okay, the reason why is because of depreciation. Questions? Righty. Obviously, I've gone to the textbook, and this is the budgeted income statement. After you've done, I mean, and keep in mind, I've just shown you a couple of these budgets. Once you've done a couple of these, it's like, it's just a matter of where you're going to pull the information, what are you going to multiply it by, divide it by, what have you. But notice what happens. All of a sudden, all these various budgets show up in my budgeted income statement. Sales show up in my sales budget. Cost of goods sold is going to be in my sales budget and some of my cost budgets. Selling, general, and administrative in the budget that I just did. Interest expense in yet another budget, a cash budget, which I'm going to show you next. So all of a sudden, all of these budgets are going to go so you can put together an income statement. Now, why do you want to put together an income statement? So when you go to the banker and ask for the loan to get you through March so you can make payroll, you can take these types of items and say, this is what we're projecting for our income statement for the year. Okay. They'll also want to see that's the budgeted income statement, the balance sheet. And you know, I mean, when my daughter says they're all made up numbers, look at how many of them are coming from various budgets. The cash is coming from a cash budget. Accounts receivable coming from that budget we did earlier. Raw materials inventory coming from one of those budgets we did. Finished goods inventory, you need one of those. Didn't do one of those, but it's kind of the same format we've been doing. Okay, land, buildings, and equipment, they're not going to change much other than accumulated depreciation, theoretically. Then current liabilities, that's going to come from one of those statements showing how much you owe everybody. Keep in mind, accounts receivable is coming from who owes you. Theoretically, common stock's not going to change much. It might change if you'd issued stock or something, but retained earnings is going to change based upon your income. Okay, and total, almost all of these numbers in the balance sheet are coming from some of those various budgets you did. And one could easily argue that the cash budget, okay, is perhaps the most important. And I want to just take us through this quick, just to kind of give us some idea of what's going on. And this is your cash. Okay, what's happening to your, and this is the one the banker is going to want to see if you come to him for a loan. He may very well ask for, let me see your cash budget. Okay, and you'd have to provide him something like this. The beginning cash was 42 grand. Keep in mind I'm rounding. How much did you collect from customers during, and this is by quarter, 230, which gives you a total of 272. Okay, and keep in mind, we've done that cash collections. How much did you do for direct materials? Well, we did one of those. That goes there. Direct labor, that goes there. Manufacturing overhead, we didn't do that one. Okay. Selling, general, and administrative. Keep in mind, this is a cash budget, so that's going to exclude the depreciation. Okay. Then if you purchased any equipment, they purchased some equipment, they paid some dividends, so total cash disbursements. So during the quarter, they dispersed 366 grand. They only collected 272, so they have a shortfall of 94 grand. Okay. Every business has some amount of cash they're comfortable with. And the way I always explain it is most of you, if you're at all like me, you have an amount you like to see in your checking account. Now it may be $100, but there is some amount that you like to see in your checking account that makes you feel comfortable. Okay, businesses have the same thing. Okay, now I don't recall what it was in this example. It looks like it's probably about 30 grand or something like that. So since they spent a lot more than they had, they borrowed money. Okay, and so then they borrowed money, which gave them an ending cash balance of 36. That ending cash balance comes up, the ending cash balance for quarter one becomes the beginning balance for quarter two. Okay, and then all the numbers that we've just calculated, and once again, they bought some more equipment, they had some more dividends, cash disbursements. They had another $36,000 deficiency. Okay. So they borrowed another 70 grand. Okay. To get their balance up to 33, which then becomes for the third quarter. Okay. Did all the same numbers again. Excess deficiency 165. Now, if I were them, I would have probably paid some of that loan back. But usually, just to make things simple in our examples here in class, we say, hey, unless you have all the money back, you're not going to pay it back. So they kept the 165 grand, went into the fourth quarter. Okay. And sure enough, they now have 263, so they can pay back the 200. They have interest on that at 21.9, interest times rate times time. So 221 cash went out, so they had 41.4 as their ending cash balance. Okay. Now keep in mind, if you went to a banker with this and you said, yeah, we need to borrow 200 grand in the first and second quarters, but we anticipate we're going to have it all back and be able to pay you back at the fourth, they're going to be a lot more likely to lend you money than if you don't, you go to them without this statement and say, well, really, I have no clue. And really, I don't know why I'm short this quarter. And I don't know when I'm going to be able to pay you back. They're going to show you where the door is. This gives you hope of getting that loan, what have you. So that's why all these budgets are so important. And you can see that every one of these budgets, and there's a lot of them, they all come and they all fit in someplace in this cash budget. And that's the cash budget, and then the income balance, the budgeted income statement, and the budgeted balance sheet are the items that kind of tie it all together. All the rest are just documents that stand on their own, that are important planning documents, but these are the ones that you're going to want to take to a banker to show, hey, I can pay you back the money, and this is how I can pay you back, and this is when I can pay you back. And this is why I think these numbers are correct. Questions? Anybody? Just so you all know, my wife was just here raising her hand saying she had a question. She really did. She was just trying to distract me? Anybody? If not, y'all have the how we do things here. So we're going to do the chapter 8 assignment. Oh well, we'll be artsy. The chapter 8 quiz. And the chapter 9 Learn Smart. And this will all be due next week. Any last minute questions? Like I've said, budgeting from our perspective here in class is really just following the instructions and taking the numbers and figuring out, putting them where they go and what have you, and just kind of following a set procedure. A lot more difficult in real life, but it's a valuable budget planning tool. And we're going to come back and use some of these types of things when we get into chapters, I'm going to say 9 and 10, maybe even next week. Any last minute questions? Have a wonderful, safe week, and I will talk to you next week.
Thank you, Mr. Sass.
Thanks.